Okay, let's unpack this. Hello and welcome to The Deep Dive, the show that cuts through the noise and gets you right to the heart of what truly matters in the world of business and innovation. Today, we're doing just that by diving deep into Merck & Co., a true titan in the biopharmaceutical world. We're talking about a company that not only impacts millions of lives daily, but one that also faces some truly monumental strategic challenges right now.
That's right. And our mission today isn't simply to give you, a surface-level overview of Merck. Instead, we're going to really dissect the intricate balance of, immense success, strategic urgency, and that ever-present ticking clock of innovation that so defines this industry. For you, our listener, we'll explore Merck's enduring business quality, we'll scrutinize the stewardship of its leadership, examine its formidable financial resilience, and then, crucially, discuss the critical risks and the powerful catalysts that are shaping its very future.
And for you, this deep dive is specifically designed to be your shortcut to truly being well-informed about Merck. We're here to equip you with those critical insights, maybe some surprising facts, and the deeper context you need to really understand this complex, captivating narrative. So let's begin right at the foundation. When we talk about Merck, how exactly does this company truly generate its economic value?
Okay, so at its core, Merck operates a classic research-intensive biopharmaceutical business model. Imagine a multi-decade cycle. High risk, yes, but potentially extremely high reward investment. The company allocates truly vast sums of capital, often exceeding, believe it or not, $13 billion annually, just into its R&D division. That's Merck Research Laboratories, or MRL. The entire objective, the singular objective of this massive spend is to discover, rigorously clinically develop, and then gain regulatory approval for novel medicines and vaccines. And these aren't just any medicines. They're therapies designed to address some of the world's most significant, often life-threatening, unmet medical needs. It's a long, arduous journey from concept to market. High failure rates all along the way.
So it's not just about finding a new drug, it's about consistently finding the right new drug. One that can make a profound impact and, ultimately get through all those regulatory hurdles. And once they do find that breakthrough, once they secure approval, what happens next? How do they actually turn that scientific discovery into substantial revenue?
Right. So, upon securing that all-important regulatory approval from bodies like the US FDA, Merck hits a period of market exclusivity. This is essentially protected by a whole suite of patents. During this crucial, time-limited monopoly, they leverage their huge global manufacturing infrastructure and a very sophisticated sales and marketing apparatus to commercialize the innovative products. Their customer base is incredibly diverse. It spans wholesalers, various retailers, large hospital systems, numerous government agencies, and of course, direct sales channels to individual physicians and veterinarians. It's a vast, deeply entrenched, and highly complex network built up over decades.
And given those enormous R&D numbers you mentioned, that $13 billion a year, I imagine the profitability on these patent-protected drugs must be quite high to make the whole model work, right?
Yeah.
Economically viable.
You've hit on a critical point there. Their profitability is indeed a direct function of the very high gross margins they can get on these patent-protected drugs. These margins often exceed 70%, and they are absolutely essential for the business model to function. Think of it this way. These high margins aren't just, a nice bonus. They're fundamentally necessary to recoup those enormous upfront R&D investments. And crucially, these investments have to cover not only the cost of the handful of successful drugs that actually make it to market, but also the far more numerous candidates, often like 9 out of 10, that unfortunately fail during that lengthy, incredibly expensive, and often frustrating development process. It's really a hit-or-miss game, and those few big hits simply have to pay for all the misses to keep that innovation engine running. Operationally, the business is structured into two primary segments, reportable segments. The first, and by far the largest, is Pharmaceuticals. This segment is truly the heart of the whole enterprise. It's responsible for roughly 88% of Merck's total revenue. Now, while it includes a broad and diversified portfolio of human health products across various therapeutic areas, its performance is overwhelmingly dictated by two dominant and incredibly successful franchises. Oncology, particularly in cutting-edge cancer treatments and vaccines. The second segment is animal health. This contributes a smaller but still significant chunk, around 9% of their total revenue. This division provides a source of incredibly stable, diversified, and predictable cash flow. They develop, make, and market a broad range of veterinary pharmaceuticals and vaccines for both livestock, like cattle and poultry, and also for companion animals, dogs, cats, horses. It's kind of a steady anchor for the business.
Okay, so pharmaceuticals is definitely the big dynamic growth engine, and animal health is the steady, reliable cash cow, if you will. But when we look at that pharmaceutical segment, what really leaps out is the extraordinary revenue concentration. I mean, it seems focused around one specific product. Is that right? And if so, what are the implications of that kind of concentration?
You've absolutely highlighted perhaps the single most critical characteristic of Merck's current business model. Their immuno-oncology therapy, Keytruda, isn't just a successful product, it's an absolute phenomenon. It defines nearly the entire enterprise's financial profile. In fiscal year 2024, Keytruda sales hit an astonishing $29.5 billion. That accounts for nearly 46% of the company's total revenue. And remarkably, it's still growing at a robust 18% year over year. Then you have Gardasil, the human papillomavirus or HPV vaccine. That brought in another $8.6 billion, or roughly 13% of sales. So if you combine just those two, Keytruda and Gardasil, they represent nearly 60% of Merck's entire global business. Now, this level of concentration offers immense operating leverage, meaning, a high percentage of each extra dollar of sales flows straight to the bottom line. Great for profits. However, it also presents a profound and frankly undeniable strategic challenge for the company moving forward. It creates a significant point of vulnerability.
Wow, nearly 60% from just two products. That's staggering. But despite that scientific complexity and the revenue concentration you just described, you've also said the fundamental business model itself has a certain simplicity and enduring quality. What do you mean by that? And how does that square with the challenges you just laid out?
Right. At a conceptual level, Merck's underlying business model is actually quite straightforward. It falls comfortably within what we might call a rational investor's circle of competence. You don't need to be a biochemist to grasp the fundamental economics, right? The company invests massively to invent medically valuable products, protects those inventions fiercely with patents, and then sells them at a price that generates a very high return on that total R&D effort. It's a clear loop, albeit a challenging one. The endurance of this model is exceptionally high because it's tethered to one of the most powerful and permanent forces in human existence, the universal desire to live longer, healthier lives. Sickness, disease, aging, these are constants, across all cultures, all times. So the demand for innovative therapies that can treat cancer, prevent infectious diseases, manage chronic conditions, it's virtually guaranteed to persist and grow for decades. Independent of economic cycles, this is the business built on a deep, structural, unchanging human need, not some cyclical economic trend. And we saw them really double down on this commitment back in 2020 when they strategically spun off their slower growth women's health and legacy brands into a new separate company, Organon & Co. That was a deliberate, pretty bold act to sharpen their focus, right? Mm-hmm. To allocate capital and talent primarily to those high-growth, innovation-driven pillars, oncology and vaccines.
That makes a lot of sense, yeah. Really honing in on where the future growth and innovation lie. But you also mentioned a central paradox with Keytruda, that it's the source of their immense profitability and future funding, but simultaneously their single greatest vulnerability because of that looming patent expiration in 2028. So for someone looking at this company today, what does this ticking clock scenario truly mean?
Well, it creates this undeniable ticking clock scenario, an urgent strategic imperative that really permeates every aspect of Merck's operations. The entire strategic narrative of Merck, from its R&D priorities to its capital allocation decisions, is essentially dictated by the urgent, critical need to replace this colossal revenue stream before it falls off that patent cliff. Therefore, an investment in Merck today is absolutely not an investment in the stability of its current earnings stream. Not really. Instead, it is, in effect, a profound bet on the enduring capability of its innovation engine, its R&D, to navigate this monumental transition. It's a forward-looking wager, essentially, on their ability to create the next Keytruda, or maybe several of them, and to do so quickly and effectively. It means the success of the company going forward is entirely dependent on its future scientific breakthroughs, not just its current market position.
That's a monumental challenge, betting on their ability to out-innovate a ticking clock. So how exactly does Merck build its competitive advantage to make that bet even plausible? What makes them so difficult to compete with, even with such a critical patent expiration looming? What creates this competitive fortress around them?
Yeah, Merck's competitive fortress. It's constructed upon an exceptionally strong foundation of powerful intangible assets, primarily its vast portfolio of intellectual properties, specifically patents, and its deep institutional R&D expertise. Patents, as we've discussed, grant the company that government-sanctioned, time-limited monopoly on its key products. This is the ultimate source of their pricing power. It allows Merck to set prices for its drugs at levels that generate those, supernormal profits required to fund the next generation of research and, importantly, to cover the vast costs of previous failures. It creates a powerful, self-reinforcing cycle. Innovate, patent, profit, and then reinvest those profits back into more innovation. Supporting that patent portfolio is the company's formidable R&D engine, MRL. This organization, with its thousands of world-class scientists, engineers, clinical researchers, and an annual budget in the tens of billions, it represents a massive, truly formidable barrier to entry for any potential competitor. It's the factory where the intellectual property is conceived, rigorously tested, developed into commercial products. That capability just cannot be easily replicated or, frankly, bought by a newcomer. The sheer economies of scale, the accumulated knowledge over decades, the vast infrastructure, the deep scientific relationships within MRL, they provide an incredibly durable advantage in the incredibly complex, capital-intensive, and high-risk process of drug discovery and development.
That's a powerful combination, definitely. Can you give us a concrete example of how this moat works in action, beyond just a general idea? How does it play out in the real world for Merck?
Oh, absolutely. There's no better real-world example of Merck's moat in action than the Keytruda ecosystem itself. With approvals for over 40 distinct indications in the U.S. alone, ranging from various forms of melanoma to lung cancer, kidney cancer, and more, its market dominance is truly staggering. This culminated in that nearly $29 billion in sales in 2024 we mentioned. Now, direct competitors like Bristol Myers Squibb's Opdivo, which is another powerful PD-1 inhibitor, right? Same class of drug helping the immune system fight cancer certainly exists. They are a real competitor. But Keytruda has firmly established itself as a foundational therapy across a multitude of cancer types. This has created an incredibly powerful brand, deep clinical familiarity, and importantly, high switching costs among oncologists. These doctors have built their treatment protocols, their patient management strategies, their clinical experience around its use. It makes it challenging, from a patient care and even medical liability perspective to just switch to an alternative unless there's a really compelling reason. It's truly become the standard of care for so many cancer patients globally.
And I've heard they're not just sitting back, that they're actively and aggressively defending this franchise as much as possible. How are they doing that in a tangible way?
Absolutely. Merck actively and aggressively defends this franchise using a multi-pronged approach. It's quite sophisticated. The company has filed an impressive 129 patent applications just on Keytruda, and crucially, more than half of those filings occurred after the drug's initial FDA approval. This is a well-known strategy in the industry called creating a patent thicket, essentially, a dense web of interlocking patents, some directly on the drug molecule, others on its formulations, manufacturing processes, or specific uses. This thicket makes it incredibly complex, time-consuming, and costly for potential generic or biosimilar competitors to navigate the legal landscape and enter the market. It basically deters them by making litigation a potential nightmare. More recently, Merck has been developing a new subcutaneous or under-the-skin formulation of Keytruda. Expected launch is late 2025. This is a classic, very potent strategy to extend the life of a blockbuster franchise. By switching patients to a new, more convenient, and separately patented version of the drug before the original intravenous formulation's patents expire in 2028, Merck aims to blunt the impact of biosimilar competition. Preserve a significant chunk of its revenue stream. Patients often prefer the convenience of an under-the-skin injection over lengthy IV infusions, right? So that can be a strong incentive for conversion. This is a direct, tangible demonstration of the company, quite literally, manning the walls of its economic fortress, innovating not just new drugs, but new ways to deliver existing ones more effectively.
So they're building new walls around the same product, essentially. A clever defensive move. But you've also mentioned that despite these efforts, the Moat's trajectory is, unusual. It's wide and deep today, but it faces a definitive, non-negotiable, narrowing event. What exactly is that event, and what are the implications?
You're absolutely right. The trajectory of Merck's moat is quite unusual. It is currently wide and deep, providing immense profitability. But it's not widening in a conventional sense. Instead, it's stable, but faces a definitive, non-negotiable narrowing event, what the industry calls the patent cliff. The key composition of matter patents for Keytruda, the fundamental ones protecting the drug molecule itself, are set to expire in 2028 in the US and 2031 in Europe. This isn't a gradual erosion, it's a precipitous drop-off. The moment market exclusivity is lost, lower-cost biosimilar versions of Keytruda will enter the market. An historical precedent across the pharma industry suggests prices and revenues for the branded product will decline precipitously, often losing 80% or more of their value within just a few years as competition ramps up. And compounding this already significant threat is a changing regulatory landscape in the U.S. The U.S. Inflation Reduction Act, the IRA, has introduced a mechanism for the government to directly negotiate drug prices for Medicare. It impacts certain high-cost, long-standing drugs. Merck anticipates that Keytruda, given its huge sales and market presence, will be selected for this negotiation process in 2026. With the negotiated lower prices taking effect in January 2028, the very same month its primary patent protection is expected to lapse, so this creates the potential for a double blow. First, a government-mandated price cut, followed almost immediately by biosimilar competition. So, while the moat remains formidable today as Keytruda continues to gain new approvals and expand its reach, the outer wall of that fortress has a clearly marked expiration date that is rapidly approaching. The company is in a constant high-stakes race against a clock of its own making, really. This reality means the long-term investment case cannot rest on the durability of any single product's moat, no matter how powerful it is right now. It must instead rest entirely on the durability and productivity of the process that creates these moats, that powerful R&D engine. The central, indeed defining question for a long-term investor is whether this innovation engine can build new fortresses faster and more effectively than the old ones are scheduled to crumble.
That's a fantastic and, frankly, quite stark way to put it, building new fortresses faster than the old ones crumble. It also makes me wonder, how does such a dynamic and high-stakes environment align with, or maybe even challenge, traditional investment principles? What's fascinating here is how this business fits into some classic mental models that help us understand complex situations.
Indeed, yeah. Several powerful mental models from the canon of great investors beautifully illuminate Merck's unique characteristics and its strategic dilemma. First, let's think about the Red Queen effect. This concept, drawn from Lewis Carroll's Through the Looking Glass, basically says, it takes all the running you can do to keep in the same place. This is a perfect, almost poetic description of the research-based pharmaceutical industry, and Merck specifically. The company must invest tens of billions in R&D annually and fend off ferocious competition from other well-funded giants simply to replace the revenue it is guaranteed to lose from its expiring patents. Its massive R&D budget isn't solely or even primarily for growth. A significant chunk has to be viewed as a form of maintenance capital expenditure, just to sustain the enterprise's current intrinsic value against that relentless patent erosion. Then there's the circle of competence. While the underlying science can be incredibly complex, we're talking molecular biology, immunology, the business model of Merck is, at an economic level, highly understandable. An investor can readily grasp the dynamics of patent-protected monopolies, the high financial risks of clinical trials, the enduring inelastic drivers of demand for healthcare, without needing to be a world-class biologist, right? The business's fundamental economic characteristics, its core mechanics, fall comfortably within a rational investor's circle of competence. It allows for informed decision-making. And finally, we have creative destruction, a concept from the economist Joseph Schumpeter. This model describes the process of industrial mutation that incessantly revolutionizes the economic structure from within, destroying the old one, creating a new one. Merck is a quintessential participant on both sides of this equation. Its own innovations like Keytruda have creatively destroyed previous standards of care in oncology, dramatically improving patient outcomes, rendering older treatments less relevant. Great for patients. However, the company now faces the constant threat of being disrupted itself, either by a competitor's superior new drug offering an even better standard of care, or by the eventual destruction of its own monopoly through biosimilar competition after 2028. The company's long-term survival, its ability to thrive, is entirely contingent on its capacity to continuously innovate and, in effect, strategically destroy its own profitable revenue streams with newer, better, and newly patent-protected products. It's a never-ending cycle of reinvention.
That's incredibly insightful. It truly is a constant race, an endless cycle of innovation and defense, a fundamental tension right at the heart of the business. Let's shift gears a bit now and gather some on-the-ground intelligence, what you might call scuttlebutt. How do customers and employees actually experience Merck, and what's the qualitative feeling about the company from those who interact with it daily?
Yeah, when we did some digging, the kind of scuttlebutt you get from talking to people looking at public feedback, it revealed a pretty interesting split in how Merck is perceived by its internal and external stakeholders. On the customer side, sentiment is highly bifurcated, sharply divided. For its core, life-altering medicines like Keytruda, patients and the physicians who treat them value these products immensely. And rightly so, for their profound efficacy. Keytruda, for example, it's a cornerstone of modern oncology, right? A therapy relied upon to extend and save lives. This is where the product itself truly shines and generates immense goodwill. However, in other areas of the business, specific commercial interactions, significant friction exists. An analysis of the company's Better Business Bureau profile, for instance, reveals 77 complaints over the last 3 years, with a concerning failure by Merck to respond to 13 of them, which kind of indicates a lack of follow-through. These complaints paint a picture of a company whose commercial practices can be a source of frustration for some. Customers report feeling misled by the fine print in rebate programs for popular animal health products like Bravecto. encountering service issues with the Home Again Pet Microchip Registry, expressing palpable anger over the high cost and perceived lack of insurance coverage for certain non-life-threatening drugs. This suggests that while the core pharmaceutical products are valued for their medical necessity and efficacy, they are not necessarily loved in the way a strong consumer brand might be. They are needed, often tolerated from a service and pricing perspective, but not always embraced with enthusiasm.
That's a stark contrast. Vital medical impact versus sometimes frustrating commercial experiences. So patients often need the core products, but might not feel great about the broader customer service aspect. What about the employees? What's the internal culture like from their perspective?
Internally, the sentiment is overwhelmingly positive, deeply mission-driven. Merck consistently ranks as a truly great place to work. It has a Glassdoor rating of 4.1 out of 5 based on nearly 3,000 employee reviews. That's pretty solid. Data from Great Place to Work is even more telling. An impressive 93% of employees are proud to tell others they work at Merck, and 91% feel a strong sense of pride in what the company accomplishes. This points to a powerful, deeply ingrained culture aligned with the company's stated purpose. We use the power of leading-edge science to save and improve lives around the world. Employees frequently describe the culture as professional, highly collaborative, and generally offering a reasonable work-life balance. This strong internal alignment and positive environment is a critical asset for a company engaged in the long, often frustrating, demanding process of scientific discovery. It helps attract and retain top talent who are motivated by impact.
So on one hand, a really strong sense of purpose internally. That's key for a research-driven company. But are there any cracks in that internal foundation? Any flaws employees frequently point out, or maybe recent points of contention?
Yeah, even a company as highly regarded internally as Merck isn't without its flaws, of course. Employees do note issues common to large, mature corporations. Things like a perceived slow career progression for some roles and the inevitable existence of corporate politics. Standard big company stuff. More recently, a strict 3-day-a-week in-office mandate has been a point of contention, a source of friction for some. Management reportedly tracking badge swipes to ensure compliance that can feel intrusive to some employees. But despite these issues, the overall internal culture appears to be a significant source of strength. It fosters that long-term focus required for sustained success in this highly competitive biopharma industry. This analysis then reveals what I'd call a goodwill gap between how Merck's employees view its noble mission and how some of its customers experience its commercial practices. The employees are genuinely motivated by the noble cause of inventing life-saving medicines, a powerful cultural asset. Helps attract and retain top scientific talent. Customers, however, must often navigate the commercial realities of high prices, complex rebate programs, sometimes frustrating service interactions. In an era of increasing political and social scrutiny of the pharmaceutical industry, this gap represents a latent vulnerability. It can subtly weaken the company's social license to operate, potentially invite further, more aggressive regulation, which could in turn erode the economic moat over time, as public sentiment often influences policy, right?
That's a fascinating point about the goodwill gap and its potential long-term implications. Definitely adds another layer of complexity. Given this operating environment, who are they primarily up against in this oligopolistic industry? Who are Merck's top competitors, and how do they differentiate themselves?
Right. Merck operates in what is definitively an oligopolistic industry. It's dominated by a handful of global giants, each possessing immense resources, deep scientific capabilities, vast global footprints. This isn't a market where new players can easily emerge to challenge the incumbents. It's tough. Among the top competitors, we see several formidable players. First, there's Pfizer Inc., a truly diversified pharmaceutical behemoth, strong presence across vaccines, oncology, internal medicine. Pfizer's strategy is often characterized by its willingness to pursue large-scale M&A to quickly acquire new revenue streams, expand its broad portfolio. They leverage massive scale, often have a deal-making culture. Then there's Bristol-Myers Squibb, BMS. This is arguably Merck's most direct and fierce rival, particularly in that critical, highly lucrative field of immuno-oncology. BMS's PD-1 inhibitor, Opdivo, competes head-to-head with Keytruda across numerous cancer types, so a direct competitor in a major growth area. BMS often focuses on targeted acquisitions, more concentrated portfolio perhaps. And finally, Johnson & Johnson, J&J, highly diversified healthcare conglomerate. Competes with Merck in pharmaceuticals, but also operates massive medical device and consumer health businesses. J&J's core strategy is leveraging its immense scale and diversification across the entire healthcare ecosystem, allows it to absorb risks from one segment with strength from another. Each brings different strategic advantages, different pressures to the market.
So a tough crowd, certainly no easy competition there. What then specifically is Merck's key durable advantage in this highly competitive landscape, beyond just having Keytruda?
Well, Merck's primary durable advantage is multifaceted, but it definitely starts with the established clinical supremacy and broad label utility of Keytruda. While BMS's Opdivo is a formidable competitor, Keytruda achieved a first-mover advantage in many indications, secured a greater number of overall approvals globally, cementing its status as the backbone of immuno-oncology therapy for a vast array of cancers. This incumbency creates high switching costs for oncologists who've spent years developing treatment protocols, gaining clinical experience with the drug. Makes it incredibly difficult for a competitor to dislodge it easily. It has truly become the standard of care in so many settings. But beyond this single product, Merck's advantage also lies in its focused and arguably highly productive R&D engine, MRL, which we discussed earlier. This internal capability to consistently discover and develop novel therapies is a strategic asset few can match. This, coupled with its stable, cash-generative animal health business, provides a degree of diversification and financial ballast that a pure-play human pharma company might lack. The animal health segment offers that steady, predictable source of cash flow to support the more volatile, capital-intensive human health R&D business. So while the competitive position is currently defined by one product's dominance, its future position, its ability to maintain its leading edge, will fundamentally be determined by the ongoing productivity of its innovation platform. It's a race not just to have blockbusters, but to create them continuously.
Okay, moving from the business itself, let's unpack the leadership. A wonderful business, as we know, can sometimes be ruined by poor management, and conversely, strong leadership can elevate an otherwise struggling enterprise. So who's at the helm at Merck, and what's their philosophy, particularly given the challenges you've outlined so clearly?
Robert M. Davis took over as CEO in July 2021, and he inherited what many would describe as the monumental task of preparing Merck for the post-Keytruda era. That's his main job, really. His public statements and strategic actions since taking the helm reveal a philosophy rooted firmly in, I'd say, disciplined reinvestment, relentless operational efficiency, and a clear-eyed sense of urgency. A key initiative under his leadership is a multi-year optimization program designed to achieve roughly $3 billion in annual cost savings by the end of 2027. Now, crucially, this isn't just simple cost-cutting for the sake of margin expansion, which can often be a short-sighted move, right? The explicitly stated goal is to reinvest these savings directly into the company's strategic growth pillars. R&D and business development, meaning acquisitions of promising external science. This demonstrates a clear, long-term, owner-oriented mindset, prioritizing future value creation, pipeline replenishment, over just short-term profit maximization. Davis's public commentary consistently reinforces this, emphasizing a dual focus, generating long-term value for our shareholders and, most importantly, deliver for our patients. This alignment of shareholder and societal interests is, in my view, a hallmark of sound leadership in this complex industry. Furthermore, the stated strategy to aggressively pursue compelling external science to supplement our internal pipeline suggests a pragmatic, non-bureaucratic approach to innovation, recognizing the best ideas might come from outside and they need to be agile enough to grab them.
That certainly sounds like a management team with a clear plan and a significant sense of urgency. Exactly what you'd want, given this strategic imperative they face. But I was wondering about how much skin in the game management truly has. What's the level of direct insider ownership? And how does that impact their alignment with long-term shareholders?
That's a very valid and important question for any long-term investor, definitely. A point of potential concern with Merck is the relatively low level of direct insider ownership. According to available data, executive officers and directors collectively own a very small fraction of the company, something like 0.05% to 0.06% of the outstanding shares. Now, for a company of Merck's immense scale and market cap, this level of direct skin in the game, meaning personal wealth directly tied to the stock price, is quite minimal compared to many other large corporations. While recent data does show more insider buying than selling over the past year, including a notable $1.3 million purchase by an independent director, which is a positive signal, the overall alignment that typically comes from significant direct ownership is, admittedly, not as robust as one might ideally prefer. So given this low direct ownership, the structure of management's incentive compensation becomes absolutely paramount, crucial for ensuring alignment with long-term shareholders. An examination of the company's proxy statement reveals a compensation structure made up of base salary, an annual cash incentive, and, most importantly, a long-term incentive plan, or LTIP. The LTIP is the most critical component for long-term alignment because it ties a significant portion of executive comp to multi-year performance. It's structured to reward a combination of traditional financial performance metrics, revenue growth, net income, things like that, and, critically, pipeline progress. The explicit inclusion of R&D milestones like successful progression through clinical trial phases, regulatory approvals, successful commercial launches of new products as a key performance metric is a strong positive. This directly incentivizes management to solve the single most important strategic challenge facing the business, successfully replenishing the product portfolio to offset that Keytruda cliff. So while direct ownership is low, the compensation structure seems, pretty well designed to align incentives with the long-term strategic needs of the company.
Right, so their bonuses and long-term incentives are specifically tied to hitting those R&D milestones and new product successes. Makes perfect sense given the Keytruda cliff. How has their capital allocation track record been under this management? Are they demonstrably spending their money wisely, strategically?
Management's deployment of capital appears demonstrably rational and highly consistent with its stated strategy, particularly in addressing that looming patent cliff. The primary, most significant use of capital is, appropriately, massive reinvestment in the R&D engine itself. Annual R&D spend is enormous, as we discussed, often over $13 billion. Furthermore, the company has committed to a substantial 5-year, $16 billion investment in capital projects specifically to upgrade and expand its global manufacturing and research capabilities. That's a crucial investment in future capacity. In terms of M&A, mergers and acquisitions, management has shown a clear willingness to make bold, strategic acquisitions to bolster the pipeline, diversify revenue streams. The cornerstone of this strategy is the $11.5 billion acquisition of Acceleron Pharma. That brought the promising pulmonary arterial hypertension drug Winrevair, so Tatercept, into the portfolio. This was a decisive move to acquire a potential multi-billion-dollar non-oncology growth driver, reducing the overall reliance on Keytruda. Smart move. Smaller bolt-on acquisitions, like the $680 million purchase of Harpoon Therapeutics, are also being used strategically to enhance specific areas of the pipeline, like cutting-edge immunotherapy platforms. And finally, on shareholder returns, Merck maintains a clear commitment to returning capital to its owners. It has a long, consistent history of paying a reliable, growing dividend, a sign of its underlying cash flow strength, and also has a significant share repurchase program in place, with $11.2 billion remaining on its authorization as of Q1 2025.
So when we look at their capital allocation decisions across R&D, M&A, shareholder returns, do they fundamentally pass the rationality test? Especially with that massive patent cliff looming in just a few years.
They absolutely pass the rationality test. In fact, I'd argue they are executing precisely the right strategy given the circumstances. Facing a well-defined, massive patent cliff, management is wisely using enormous cash flows currently generated by Keytruda to aggressively fund both internal R&D efforts and external acquisitions of promising assets. This is, hands down, the most logical and, from a long-term perspective, shareholder-friendly course of action. The Acceleron acquisition, while carrying a significant price tag, was a direct and necessary action to address the portfolio's primary weakness, introduce a new non-oncology blockbuster candidate, and the new comprehensive cost-saving program, with the proceeds explicitly earmarked for reinvestment rather than just short-term profit boosts, is further evidence of a rational, long-term mindset. Management is behaving like a company in a hurry, recognizing the urgency of the situation, which is precisely the correct posture given the strategic imperative it faces. They're deploying capital to solve their biggest problem, not to hide from it.
That makes perfect sense. Proactively addressing the challenge. Good. Now, let's talk about their financial fortress. How strong is their balance sheet? And what does that tell us about their ability to navigate these significant challenges, especially given those capital allocation demands?
Merck's financial position is exceptionally strong. I'd even characterize it as a fortress balance sheet. It provides the resilience and flexibility needed to execute its long-term strategy effectively. The company's profitability has been both high and remarkably consistent, a testament to the robust pricing power afforded by its patent-protected products. Gross profit margins are consistently in the impressive 70-80% range, while operating margins often exceed 30%. Fantastic numbers for a company of this scale. This high level of profitability translates directly into massive, reliable operating and free cash flow, which, as we know, is the lifeblood that funds the company's R&D, M&A, shareholder returns, all without significant reliance on external financing. An analysis of key financial ratios over time consistently confirms the high quality of the business. Take return on invested capital, ROIC. Merck consistently generates returns on capital well in excess of its estimated cost of capital. With the exception of an anomalous one-time accounting thing in 2023, the company's ROIC has been robust, recently exceeding 21%. That's a clear indicator of a high-quality business that can deploy capital efficiently, generating strong profits over time. Their free cash flow, FCF, conversion is also exceptionally strong. The company demonstrates a powerful ability to convert its accounting profits into actual spendable cash. In a typical year like 2024, FCF conversion was over 100%, $17.1 billion in net income, translating into an even higher $18.1 billion in free cash flow. That indicates very high quality of earnings, efficient working capital management. And finally, the balance sheet itself is indeed a fortress. The net debt to EBITDA ratio, a key measure of leverage, is very conservative, typically well below 2.0x, recently standing at a remarkably low 0.96x on a trailing 12-month basis. S&P Global Ratings, a leading credit rating agency, even forecasts the company will comfortably maintain a ratio of around 1.5x or less, even with potential future acquisitions. This low leverage provides enormous financial flexibility. It means Merck has significant dry powder to pursue large strategic acquisitions or increase R&D spending without straining its financial health. So this financial strength isn't merely an outcome of past success. It is, more importantly, a critical strategic weapon for the future. It provides the abundant resources necessary to fund that massive R&D budget year after year, and gives management the crucial dry powder to act decisively on M&A opportunities, as it did with Acceleron. This financial fortress provides the optionality and stability required to confidently solve the strategic problem of the Keytruda patent cliff, allowing management to play offense when it's most needed, rather than being constrained by financial limitations.
Okay, with such a solid understanding of the business itself, its competitive dynamics, its leadership, let's now consider how the market views Merck. What does the current valuation profile tell us? And what are the big unknowns shaping that perception?
Yeah, historically, Merck has traded with the valuation profile of a mature blue-chip pharma company, often at a modest discount to the broader market, reflecting those inherent cyclical risks of patent expirations. That's normal. However, the current market valuation exhibits a profound, almost palpable level of skepticism, I would argue. The company's forward price to earnings, or PE, ratio is in a remarkably low range, somewhere between 8.8x and 12.9x, depending on which forward earnings estimates you use. This is a significant discount, not only to the broader S&P 500 average, but also to many of its direct peers. Crucially, this valuation is also well below Merck's own long-term historical average PE ratio, suggesting a deviation from its typical trading multiple. Something's different now in the market's eyes, and the market's reasoning for this pronounced discount is unambiguous. It is unequivocally largely pricing in the 2028 Keytruda patent cliff. Full stop. The current stock price appears to reflect a high probability in the market's collective mind that Merck will fail to replace a substantial portion of Keytruda's multi-billion-dollar revenue and earnings stream. Essentially, the market isn't valuing the company as it exists today, with its current high profitability and dominant products, but rather for a potentially much smaller, less profitable, significantly de-risked version of the company in 2029 and beyond, after the cliff hits. It's anticipating a structural decline. That's why the multiple is so depressed.
That's a pretty stark assessment from the market. A lot of pessimism baked in. So given that, where would the margin of safety for a long-term investment like Merck lie? What conditions would create that protective buffer for an investor?
Right. For a long-term investor, a robust margin of safety, thinking like Benjamin Graham, is about demanding a significant discount between the price paid for an asset and its underlying intrinsic value. For an investment in Merck, such an opportunity could be established under several conditions. One scenario could arise from a market overreaction to a short-term, company-specific but temporary setback. This might include, for example, a temporary manufacturing disruption impacting a non-core product, a minor clinical trial delay for a non-essential drug in the pipeline, or maybe a quarterly earnings miss driven by transient factors like fluctuating Gardasil demand in China, something temporary. Such an event, if it leads to an irrational sell-off, could push the stock price down, allowing an investor to purchase the durable long-term innovation engine at a price that excessively penalizes a temporary solvable issue. Another scenario for a margin of safety would be a broader market-wide panic, a general stock market crash, or a healthcare sector-wide sell-off, driven by unrelated macroeconomic fears or broad political rhetoric about drug pricing that doesn't specifically target Merck's fundamentals. That would provide an ideal opportunity. This would allow for acquiring shares at a deep discount to a rationally calculated intrinsic value that considers the company's long-term prospects. And finally, a very compelling argument can be made that the current valuation itself may already contain a significant margin of safety. If our analysis, and perhaps a contrarian view, concludes that the market is overly pessimistic about the potential of Merck's extensive pipeline and management's proven ability to navigate the cliff, then the current depressed price itself offers a substantial buffer. The margin of safety in this case is the inherent gap between the market's dire, perhaps extreme forecast and a more optimistic yet still conservative assessment of the company's future prospects.
That makes perfect sense. Buying when there's an irrational discount. Classic value investing. It also brings to mind Warren Buffett's wisdom. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. How does that apply to Merck here, given its current situation and valuation?
That wisdom is profoundly relevant here. Our analysis up to this point strongly suggests that Merck is, by many qualitative measures, a wonderful company. It possesses a powerful, though finite, economic moat, has rational, seemingly aligned management, boasts a fortress-like financial position with robust cash flows, all good things. However, the ultimate return on investment will always be dictated by the price paid. Always. If an investor pays a price that fully assumes a successful replacement of Keytruda's earnings, well, the potential for outsized returns is inherently limited. Success is already baked into the price. Conversely, if one can acquire a stake in Merck at a price that largely discounts this possibility, as the current market valuation seems to do quite aggressively, the investment profile becomes highly asymmetric. It essentially creates what some might call a free option on the successful execution of the pipeline and management's strategic plan. What does that mean? If management does succeed in filling the revenue hole and driving growth, the market will eventually be forced to re-rate the stock to a higher multiple, leading to substantial revaluation and considerable returns. If they only partially succeed, the low entry price provides a crucial cushion against the risk of a permanent loss of capital. In this scenario, price truly is the final, most critical variable in the investment equation. It allows an investor to participate in the upside with a potentially limited downside, assuming the core business maintains its quality.
So the price you pay now factors in so much of that future uncertainty. Very interesting. Let's shift our focus now to what really drives Merck's future growth, and on the flip side, what could permanently impair its earnings power and long-term value.
Okay. The single most important identifiable driver for Merck's future earnings growth is the successful execution and commercialization of its extensive late-stage R&D pipeline. This isn't a single product, remember. It's a vast portfolio of opportunities currently under development. To give you a sense of scale, the company has over 30 programs in phase 3 clinical trials. That's the final, most expensive, most critical stage before regulatory submission, and more than 50 in phase 2. Management has publicly stated that it has approximately 20 new drug candidates in development that it believes have blockbuster potential, each capable of generating over $1 billion in annual sales. Collectively, these represent a combined theoretical sales opportunity of an astonishing $50 billion. This formidable pipeline is the engine that must not only replace the colossal revenue from Keytruda, but also drive the company's growth well into the 2030s and beyond. Its success is paramount. Now, regarding permanent impairment risks, these are the genuine long-term threats that, if they materialize, could fundamentally and permanently damage the business's earnings power, lead to a significant, lasting decline in intrinsic value. The most significant and, I would argue, probable long-term risk is catastrophic pipeline failure. If key candidates like Winrevair, the new Subcutaneous Keytruda, or the next wave of oncology or immunology assets, if they fail late-stage clinical trials, or if they get unexpectedly narrow regulatory approvals that severely limit their commercial potential, the company will be unable to fill that enormous revenue hole left by Keytruda. This would lead to a permanent, irreversible impairment of its earnings power and would ultimately justify the market's current pessimism. Drug development is inherently risky. Most drugs entering trials never make it to market. That's just the reality. Another major risk is drastic regulatory pricing action. A fundamental government-led shift in drug pricing policy in the U.S. or other major global markets could permanently impair the profitability of the entire pharmaceutical industry, not just Merck. The Inflation Reduction Act is the first major step in this direction in the U.S. Its impact is already being factored into long-term planning. However, more aggressive future regulatory regimes, say, expanding price negotiations to more drugs or to private payers, could structurally lower the returns on R&D investment, undermining the fundamental economic model that underpins the biopharma business, permanently reducing its intrinsic value. Lastly, there's a lower probability but higher impact black swan risk, a major scientific disruption. This would be the development of a completely new, revolutionary therapeutic modality by a competitor. For example, a groundbreaking new cancer vaccine, a fundamentally different gene therapy, an entirely new form of cell therapy, something that could render Merck's core technologies, like PD-1 inhibitors like Keytruda, obsolete. While difficult to predict, this is a risk inherent to any technology-driven industry relying on a specific scientific approach. Innovation can rapidly bypass existing paradigms.
Those are certainly some serious long-term threats. Investors need to consider those carefully. On a more positive note, what are the specific catalysts that could truly make a difference for investors in the near to medium term? What could unlock significant value, maybe re-rate the stock in the coming, say, 1 to 3 years?
Right. Beyond the long-term growth engine of the extensive pipeline, several specific events in the next 12 to 24 months could serve as powerful catalysts to unlock or accelerate value creation for Merck. First and foremost is the successful commercial launch of Winrevair, Sotatercept. This newly approved first-in-class therapy for pulmonary arterial hypertension, or PAH, a rare, severe lung disease, is a critical near-term catalyst. The drug generated an impressive $280 million in its first full quarter on the market. That's a very strong start for a new launch in this space. Analysts have peak sales estimates ranging from a conservative $3 billion to a highly optimistic $8 billion annually. Big range, but significant potential. A strong launch trajectory over the next 12 to 24 months would provide the market with tangible proof that Merck can successfully develop and commercialize new, non-Keytruda blockbusters. That could lead to a significant re-rating of the stock as the market gains confidence in its ability to diversify. Second, and equally important given our earlier discussion, is the approval and successful adoption of Subcutaneous Keytruda. The expected launch of this under-the-skin formulation is late 2025. It's a pivotal event for protecting the franchise. If Merck can successfully and rapidly transition a large percentage of patients from the IV infusion to this more convenient formulation before the original patent for the IV version expires in 2028, it could significantly defend the Keytruda franchise from biosimilar erosion. This would effectively soften the patent cliff, preserve a substantial portion of the product's cash-generating life well into the 2030s, and, crucially, buy the rest of the pipeline more precious time to mature and come to fruition. These two catalysts are truly key to bridging that revenue gap and validating Merck's post-Keytruda strategy in the eyes of the market.
That's a great overview of the near-term drivers and how they could potentially change the narrative. Now let's challenge ourselves to go beyond the obvious here. If we connect this to the bigger picture of market behavior, how can we apply second-level thinking to Merck, moving past the surface-level narrative that seems to be dominating the conversation?
Okay, to move beyond a superficial analysis, we need to compare the prevailing market narrative with a deeper, more contrarian view. The current prevailing market narrative that's the embodiment of first-level thinking is one dominated by fear and uncertainty. It's focused almost exclusively on the 2028 Keytruda patent cliff. The consensus view, as reflected in the stock's deeply discounted valuation, is that this event represents an almost insurmountable obstacle, that Merck's future earnings power is highly uncertain, likely to be significantly diminished. It's a straightforward, almost simplistic analysis. Company loses best-selling product, therefore stock is risky and less valuable. However, a second-level analysis suggests the market may be suffering from a form of spotlight bias, focusing so intently, almost myopically, on the one large, obvious risk, the Keytruda cliff, that it is systematically undervaluing the rest of the enterprise. The contrarian view is that the market may be significantly underappreciating three critical factors. First, the sheer scale and potential of Merck's late-stage pipeline. The market appears to be assigning little to no value to a pipeline with over 30 Phase 3 assets and a stated potential of $50 billion in future annual sales from new blockbusters. While pipeline development is inherently risky, success never guaranteed, the consensus view seems to imply an almost zero probability of success for these new assets, which is, an extreme and statistically unlikely position. Second, the market might be unduly discounting management's proven execution capability, underestimating the ability of a seasoned, rational, highly motivated management team to navigate a well-understood, albeit difficult, strategic challenge. The team's aggressive, logical actions to date, Organon spinoff, Acceleron buy, cost optimization, are simply not being fully credited in the valuation, it seems. And third, the value of the non-Keytruda assets themselves. In its intense focus on the Keytruda cliff, the market may be ascribing little to no value to the other durable, high-quality, cash-generative assets within Merck. This includes the highly stable, profitable animal health division, the incredibly durable Gardasil vaccine franchise, which is still growing, and the rapidly emerging blockbuster Winrevair. These existing businesses offer a floor of value that might be overlooked. The second-level conclusion, then, is that the current price may offer a compelling opportunity. It potentially allows an investor to purchase the existing, high-quality, non-Keytruda businesses at a fair price, while effectively getting a free look or a deeply discounted option on the massive upside potential from the successful execution of the company's post-Keytruda strategy. It's a bet on the long-term innovation engine and management's ability to pivot, which the market seems to be heavily penalizing right now.
That's a powerful argument for looking beyond the obvious narrative and employing that second level of thinking. Let's bring it all together now into a concise investment thesis summary. Maybe the one-pager for someone considering an investment in Merck.
Okay, for the bull case, the primary reasons to own Merck boil down to these points. First, it's a wonderful business at a fair or arguably even discounted price. We're talking premier, research-intensive biopharma. Wide, though finite, economic moat. Exceptional profitability, fortress balance sheet. All currently acquired at a valuation reflecting deep, likely excessive pessimism about its future. Second, proven and demonstrably aligned management. Current leadership has correctly identified the primary challenge, that 2028 cliff, and is executing a rational, aggressive, owner-oriented capital allocation plan to address it. Through focused internal R&D, strategic M&A, operational efficiency, their actions speak volumes here. Third, there's a massive, fundamentally undervalued pipeline. The market, in its narrow focus on the certainty of Keytruda loss, is failing to properly value a deep late-stage pipeline with multiple potential blockbusters, including the already launched Winrevair and the critical Subcutaneous Keytruda. These assets have a credible chance of filling the earnings gap and driving substantial future growth. And finally, durable demand and diversification. The core business serves a permanent, growing human need for better health globally. And the highly stable, profitable animal health segment provides valuable diversification, a consistent source of cash flow supporting the more volatile human health R&D cycle. That stability provides a significant foundational layer of earnings.
But of course, with every opportunity, there are significant risks. Must be considered, rigorously challenged. So what's the counter-thesis? The bear case for Merck that could undermine this bullish outlook?
The bear case is equally compelling, demands serious consideration. Absolutely. First, the cliff is undeniably real, and it is potentially insurmountable. Losing nearly 50% of revenue from Keytruda in 2028 is an enormous hole. May simply be too large to fill, even with a promising pipeline. Pipeline risk is inherently high. Trials fail frequently. No guarantee of success for even the most promising candidates. Pharma development is just fraught with uncertainty. Second, intensifying regulatory and political pressure. Governments, like the US via the IRA, other global payers, they're becoming increasingly aggressive on drug pricing. This is a secular trend, could permanently impair profitability and long-term R&D returns for the entire industry, regardless of individual innovation success. Makes it harder to justify those massive R&D investments. Third, high execution risk. Management strategy is complex, relies on near-flawless execution of numerous late-stage trials, successful global product launches for multiple new drugs, smooth integration of large acquisitions, all happening currently within a very tight time frame. A significant misstep in any of these critical areas could be disastrous, lead to failure to meet expectations. And finally, as we discussed, there's a perceived lack of significant skin in the game. That very low level of direct stock ownership by senior management means alignment with long-term shareholders is primarily driven by compensation plans, which, while well-designed, may not be as powerful a motivator as significant personal fortune tied directly to stock price performance. Raises questions about commitment if times get truly tough.
That's a clear, well-articulated counter-thesis. Outlines the substantial hurdles to really push our thinking, implying that mental model of inversion. If we inverted the bull case, how could this investment become a permanent loss of capital? Or perhaps more likely, a multi-year value trap where capital is just tied up with no return?
Right, applying inversion. We must aggressively challenge the bull case by asking, how could this investment become a permanent loss of capital or a multi-year value trap? The most compelling argument for this investment being a major long-term mistake is falling for a classic value trap. The bull case rests on the potential of the pipeline, future breakthroughs, while the bear case rests on the certainty and magnitude of the patent cliff. The critical error for an investor would be to overestimate the probability of the former while simultaneously underestimating the financial impact of the latter. This is where many value traps ensnare investors looking cheap on current earnings but having future earnings that are fundamentally impaired. Let me paint a plausible, if grim, scenario for how this could become a major long-term mistake. Imagine this. The launch of Winrevair, while initially successful, ultimately peaks at the low end of expectations, say $2-3 billion in annual sales. Fails to become the mega blockbuster needed to truly move the needle. Simultaneously, the transition to subcutaneous Keytruda is only moderately successful. Captures less than 50% of the patient base before a flood of low-cost biosimilars fully erodes the entire franchise post-2028. To compound matters, one or two of the other key phase 3 oncology or immunology assets in the pipeline fail in their pivotal trials or get unexpectedly narrow regulatory labels, severely limiting their commercial potential. And in addition to all this, the U.S. Inflation Reduction Act expands its reach or is replicated in other major international markets, leading to steeper than expected price cuts on Merck's other successful non-Keytruda drugs like Gardasil and other newly launched products. In this scenario, Merck successfully replaces only a fraction of Keytruda's massive earnings. The company survives, yes, but it enters a decade of stagnant or even declining revenues and profits. The stock, which appears inexpensive today based on current earnings, would languish for years. The market correctly identifies it as a melting ice cube, a company whose underlying earnings power is shrinking. The investment would become dead money at best, a permanent impairment of capital at worst, as the company's fundamental earnings power is structurally permanently reduced. This, ultimately, is the primary risk that a prudent investor must fully underwrite and comprehend to justify an investment in Merck today. It's the challenge that defines the entire investment proposition.
That's a truly sobering scenario, and a crucial one for any investor to consider deeply before making a decision. What a detailed deep dive into Merck & Co. It's clear this is a company facing pivotal challenges, absolutely, but also one with immense capabilities and a long history of innovation.
Indeed. And if we connect this back to the bigger picture, it raises an important question that really transcends just Merck. In an industry so fundamentally defined by relentless innovation and constant change, how do we, as informed observers, potential investors, how do we truly weigh the promise and inherent uncertainty of future scientific breakthroughs against the certainties of current challenges, particularly those like patent expirations? It's a fundamental tension, a core paradox that shapes not just Merck's future, but the entire pharmaceutical landscape for decades to come.
A truly profound thought to leave us with. Thank you for joining us on this deep dive into Merck & Co. Keep that curiosity burning, and we'll see you next time.